Well, Harold, with the market direction a little unclear at this juncture, what are your thoughts on trading QQQ from an options perspective?
Yeah, so exactly what you just said. The market is unclear. Really no sign. It's hard to determine what direction is going to be. So that's my reasoning, my thesis behind doing an iron condor. An iron condor is a neutral trade. So it's designed for a market moving sideways, not much to the upside or to the downside. So that's one I'll walk you through. So let me switch my screen over to I think or swim. Let me get set up here.
Sounds
And
like a plan. So the Iron Condor is a spread of
okay, it's
spreads.
not letting me uh
So sorry, do I need to make you co-host? Did I
yeah,
mess up? Yep, I did.
okay.
So we've got four legs to this trade, right?
Right. So it's
Sounds like a
four legs.
plan.
So you got a bull put spread and a bearish
Bear
call
call.
spread. And let me switch my screen over here. All right, so you should be seeing my trading platform. So you can see QQQ in the upper left. That's what we're going to be looking at. QQQ. Most of you know it's the ETF for the Nasdaq 100. So I'm going to start out. I'm going to go out to the October expiration, October 20th expiration, which is 53 days out. I like to set up my option trades anywhere between 45 to 60 days out. So 53 days out is where I'm going to start. So I expand on that, and I'm going to start by on the put side. I'm going to sell I got a lot of scrolling to do. So I'm going to sell the 340. I'm going to sell that, and then I'm going to buy the 335 for protection. So that's my put spread. On the call side, I'm going to start by selling the 387. So I'm selling the 387, and then I'm going to buy the 392 for protection. So that's going to give us a credit of $1.76. We're $5 wide on both sides. And now let's take a look at the numbers here. So I'm going to click on confirm and send. And first thing I like to look at is the break even. You want to keep an eye on the break evens. You want to keep an eye on these numbers because I'm going to use these as my stop losses. So you got 338 to the downside, 388 on the upside, and then of course our max profit. That's the credit received. So let's take a deeper look into the numbers. We're going to look at our probability of success and how many contracts we're going to buy. So over on the left side, I've got some notes here. So we're going to start out with the probability of success. It's a two-step process to calculate this. So first thing we need to do is calculate, okay, what is our actual risk? And the way we determine that is we take the width of the spread minus the credit received, which is $1.36. Let me lock that in here. It's $1.76, I'm sorry. So that's going to give us our actual risk of $324. So that $324, that's our actual risk. To determine the probability of success, we take the width of the spread divided by 5, and then we multiply that by 100. That's going to give us a probability of success of 64.8%. So far so good. Let's look at the return on risk. We know how much capital we're putting up. What kind of return can we expect? To calculate that, we take the credit received divided by our actual risk. So that's a credit received is $1.76 divided by the actual risk at $3.24, and that's going to give us a return on risk of 54.32%. We got the percent sign there. All right, so far so good again. So how many contracts are going to buy based on the numbers that we've seen? To determine that, we determined that we're going to put $2,500 into this trade. That's all based on our account size, our level of risk, etc. So we're going to take that $2,500 divided by our actual risk, which is $324. That's going to give us 7.72 contracts or 7 contracts. All right, so I can change the numbers here to 7, or, since I'm a little bearish on the market, a little hesitant in the market, I'm not going to put all 7 contracts in there. I'm going to be small. You want to be small in this market, so I'm just going to do 5 contracts. So let me change that to 5 contracts. And then let's take a look at the numbers here. I'm going to hit on confirm and send. And then, of course, our break evens, that doesn't change. Here's our max profit. And then again, we're not going to put that $2,500, all of it to work because of the market conditions. And looks like we're already giving back some of our gains today. So those are the numbers there. How do we manage the trade? So first thing we want to do, remember that break even. That's going to be our stop loss. And then our profit, what we're looking for is 25% of the credit received. In this case, it's 44 cents. And then we're going to manage the trade at 21 days to expiration. So I'm going to keep an eye out on this number here. So if I don't get my profit, my profit, and I don't hit the break evens, then I might say, well, I'm just going to close out the trade. I got a little bit of profit, or it's not working. I just might close it out. That decision is going to be made when we get to 21 days to expiration. So I'm going to send this trade off, and hopefully we get filled here.
And Harold,
Right.
I know I've asked you this before, but do you ever kind of separate the trade out and say, oh, you know what, my bear call spread is working, and I've got a good profit on that because it went that direction. So I'm going to take that spread off and see if there's volatility, maybe it can hit the other one, or do you just kind of do an all or nothing?
Me, I'm an all or nothing, and I've thought about that. I might do it this time around just to check it out. I started to do it the last condor trade. I forget what stock it was. I knew it was a stock, and I'm going to use the analyze tab to see. Okay, well, if I take this part of the spread off, okay, what's going to happen? So
Mhm.
in Thinkorswim, you got an analyze tab, which is a great tool. So I'm going to put it in there and see, what's going to happen. But to answer your question, no, I usually, when I'm in the trade, I close it out, the entire trade, no matter what.
Mhm.
Right. Well, Harold, the audience really loves when we let them peek behind the curtain here. So this is a simulated trade for educational purposes, but you put on a lot of
Oh
the
yeah,
trades
yeah.
as well, right?
That's my first objective is I'm looking for something for my own portfolio, and we did get filled. So I'm looking for something for my own portfolio, and then I
Right.
said, okay, this is what I want to trade. Okay, that's going to
Mhm.
be the trade I'm going to share here
Right.
with the audience here.
Exactly. Because one of the reasons too why we do it from a simulated account is because otherwise, if you were showing us with your real account, we would see all your numbers, which are really personal, So we're protecting your account information there. And the other thing is, Harold, we're getting questions from the audience about how you factor in commissions for these trades.
Mhm.
I saw on that little confirmation screen, the credit was 880 and there was a $13 commission fee.
Yeah.
Your thoughts on that?
Yeah, yeah. So there's always going to be commissions, and I don't factor that in. I'm more looking at, okay, is this trade going to work? So I don't look at commissions. I know this commission is going to be paid, um, and you speak, and then and the same thing with taxes. I don't consider taxes on my trades either, and many times I will use another platform because closing out the trade on the way out is commission free. This is on Tastyworks. Thinkorswim, you got commissions going in and going out. So that's another reason why we don't share the account, because I don't do everything in Thinkorswim. I go between two trading platforms.
That makes sense. And then last question for you, Harold, on why focus on options? Why focus on these strategies? Why not buy stocks? Clearly, this is a profitable strategy for you, or
Yeah,
these are profitable strategies.
right. I like to trade. So because of the leverage in options, it allows me to do more trading. Yeah, so that's my reason behind it. And so I put these trades on, and then I'm always going to be looking for others. If I'm just buying the equity, that's going to eat up a lot more of my capital. So the trading the options is much more capital efficient.
And let's go back to Market Smith, and I've drawn the break evens roughly 388. and 338. So we can just see on the chart here where those break evens are. Harold, your
Right.
thoughts on these break even levels?
So yeah, so we've got a wide range to the upside and to the downside. And what you want to see happen with this trade is if it stays right, right between the moving averages. So if it stays between that 21-day or around the 21-day exponential, or maybe gets up to the 50-day, doesn't get much above it. If it stays sideways for the next, what was it, 53 days, this trade is going to work out very well.